Hello and welcome. My name is Josh and this is Finance Soup. And today I want to do something a little different. Typically, I've been talking about companies that I already own, but today I wanted to go over a bit of my process for when I'm looking at a new company that I don't currently own and how I do that and use an example of a company I recently started looking at. So let's just jump right in. So the first thing I do, and I think you should always be doing, is looking for screeners. So screeners are a way of looking at vast number of companies and taking a basic proxy, a basic number that you think, hey, this is a good idea of if it's undervalued or overvalued, and trying to look at that. So, I have here a spreadsheet of all screeners. Oops. It's a shit ton of companies. Okay, you can see there's thousands of companies here. And we have their country, their market cap, their enterprise value, revenue, gross profit, all this. And you have to screen for what you think is appropriate. But I basically looked at a value of enterprise value to gross profit. So again, enterprise value is the value of the company to gross profit. And I tried to use that as a basic screener of what's over or undervalued. I filtered out by sector, which I can see here. And then I looked for ones that were trading below their sector, and then also had positive revenue growth last year. So again, I want companies that are growing, are cheaper than their sector. Those are the first two screeners. I actually did twice as much growth so I set like a growth threshold. I set a valuation threshold, so I want them cheaper than their sector. And then I filtered out some sectors I don't really understand. I don't really understand the agriculture sector, this sector. And after filtering through all those, I had a list of maybe from thousands to 50. And I looked through those companies and I said, which do I understand or have heard of? And from there, I found one that I thought stood out. And so that's what I'm going to be talking about. It's iRobot Corp. iRobot is the company that makes Roombas. So we're going to look at them today. And I think it's an interesting one. So what are Roombas? If you don't know, Roomba. It's a little tiny robot that goes around your house and vacuums. And funny enough, a friend of ours actually just got one after I was looking at this. So I thought it was very prophetic how, I was looking at the company and then a friend said, oh, I love my Roomba. So again, when I look at when I'm looking at any company, do I understand the product? Is it a good product? So product value is one. Do I understand it? Do people like it? My friend loved it. He was so pumped about his Roomba. Two, is it a growing market or their macro trends? And three, valuation. So valuation, the screener should give you a good gut feel of the valuation, but it's not going to be perfect. So I want to go over another tool I use often. So I understand the product. I've heard of them for a while, and my friend kind of raved about it. So that checks that box. Valuation was pretty much, the screener helps me get a decent understanding, but I like to go deeper. This is a site I like, Finbox. It gives a good understanding of a DCF. So DCF is a discounted cash flow. It is what is the future value of this business based on their revenues and their gross and their earning potential, right? So it's not just revenue, it's how much money they make from that. So you can do it on operating profit or EBITDA. So here, this site uses EBITDA. You type in a ticker. So, you can do Peloton, you can do this. I did iRobot here. And then there's some assumptions. So I always look at, you don't just want to take it for face value. I always make some adjustments based on my thing. So first, you look at growth. So what's the growth rate? And sometimes you'll see some weird things like, why is it going -10 and then 0, 0, 0, 0? I think that seems strange that they would be growing at 10%. And you can see their 10-year compound annual revenue is 2.5%. I think that sounds a little low considering they grew 17% last year, 10%, and they're expecting them to grow about 10. And then like even 70% of negative growth. So I even just bumped that down to, let's say 5%, 4%, 3%, 2%, 2%. I think this is fairly conservative. 2% is very low growth, but let's go with it. I'm not going to touch the EBITDA. I almost never touch the EBITDA margins unless I really think they're wrong. Last year was 12.9. They're projecting about 11.7. Seems about right. Again, if I was seeing negative and last year they had positive, I'd change that up, but for the most part, I don't touch that, but I do look at the revenue growth. We see here it says 45% upside. But hold on. We got to keep going. Okay, so the biggest ones I touch, I do look at everything with the CapEx. Again, looks reasonable. Working capital looks reasonable, it's about the same. D&A, depreciation, amortization, looks reasonable, looks about the same. Tax rate, reasonable. Discount rate. So this is a big one. This is what you're discounting the future cash flows at. So I typically go 8% for discounted cash flow or discount rate. You can go less, you can go more. This is really like what kind of return. You can look at this as what kind of return you want. So, hey, I want to get a 10% return. Well, now it looks like it's fairly valued. So that would actually mean that it's getting a 10% return based on this. I like to use 8, which is just slightly more than the stock market on average return 7. But I still then like to see a little bit of a buffer. So again, you can play with this how you want, but I like looking at that. But you can see this would change it drastically. If you go 1%, or it won't even accept 1%, 2%, there, 3%. It says it's worth thousands of dollars. If that's all you wanted, if you just want to discount at 7%, 3%, it's worth a ton. So make sure you're doing something reasonable. 7 to 10% is reasonable. 7 is the stock market. 8% is a little bit better. Some people use 10%, which is an aggressive one. And if it's a very risky company, you might go even up to 15%. But I'm going to stick with 8%. And then the last one's the terminal value. This is another one that's going to have a huge impact on your thing. This is what will the company continue to grow at forever? So again, I typically go 2.5%, which is the size of the economy. It's roughly inflation. It basically says the company is not going to grow or shrink. It's just going to kind of go up with the rate of inflation. Obviously, if you change this to 5%, again, has a huge impact on the price. 10%, it won't even go that high because it's saying it's too much. But here, 7% says it's worth way, way, way more. You could do 0% and then it's worth less. But let's go with, let's go 2%. I think in my revenue, I said it's growing at 2%-ish. So this says it's growing less than inflation slash the GDP growth. So these are very conservative assumptions. Again, I'm using a higher rate than the stock market, which is 7%. I'm using lower rates than typically I use 2.5%. Here I'm using 2. And again, I did very conservative revenue growth. Again, you're seeing 5.7% revenue growth CAGR over the next 10 years. CAGR stands for compound annual growth rate. They grew 17.8% last year. And it says it's 22% upside. So it seems like, checks out, it seems like it's undervalued. Okay, what else could be benefiting this? So then we look at the macro. That's the last thing I haven't looked at. And from the macro environment, the way I see it is we've seen inflation go up lately. We've seen wage inflation go up. There's a huge number of job openings right now, and places like Walmart and Amazon have to raise their prices. Places like Domino's and other places have said, hey, we can't afford, our revenue is actually down because we can't find enough people to work at these jobs, to work at restaurants and these lower wage jobs. I actually see this as a huge boon for iRobot. If wage growth continues up, we're going to see more automation in the sectors that are low wages. So in other words, more automation in the restaurant industry. So instead of someone making your pizza, maybe instead of 10 people making pizzas, you'll have 2 people making pizzas along with robots that will do most of the making. Because when wages are cheap, it doesn't make sense to automate. That's why most t-shirts are made in Indonesia and overseas. They were made in China and all that because wages there were so low. As wages go up though, the cost benefit analysis says, okay, instead of paying this person $1 a day, if I have to pay them $15 a day, it might make sense to build a robot and teach the robot how to sew shirts. We're not there yet because we can have wages overseas where it's way cheaper. But here, wages in fast food restaurants are going up. So I'm also very bullish on any automation tools that help, like these robo restaurants where like a robot makes the pizza. I'm very bullish on that. I think that's going to be huge. iRobot, I think, is going to benefit from the same kind of thing. If wages for janitors and cleaning staff continue to go up, then I think that you're going to see places start to automate more and more of those cleaning services with services like iRobot. So again, this is being very conservative on the revenue. Basically right now they're mainly selling to consumers like you or I who want to just clean their homes. I think there's a huge potential for the commercial side of this business. So to me, I look at, hey, it's a product, people like it, I understand it. People want to not have to clean their house. I can completely relate to that. The stock seems fairly valued, if not undervalued. And I see huge upsides as wages continue to go up, that there could be more and more automation in this sector of the world, sector of, you know, automating low wage jobs away with robots and automation. So I'm a big believer in this. I think there's a lot of upside here. So that's kind of the process that I look at when I'm looking at a new stock. I use a screener to try and find stocks. I try to look at ones I understand and think have upside based on their sector of the market. I then plug in, to DCF. I either do it myself or I like Finbox. It's an easy way to get some to quickly do a DCF. I see if it's undervalued. So again, this one checks valuation. This one checks the box for macro environment, and this one checks the box for product. So I will be looking much deeper at iRobot. I might even take a position in the next 24 to 48 hours. I'm a big fan, so hopefully that was of value to you. Check out iRobot, do your own research. This isn't advice, but I think that this is an interesting company. So yeah, I'd love to hear your thoughts. Thanks so much. My name's Josh Lipton, and thanks for watching.